Wow. Okay, let's talk about Intel. The company has been on an absolute tear lately, with a monster rally that has just about everyone in the market talking. It's shaping up to be one of the biggest comeback stories of the year, but you have to wonder, has the hype gotten way ahead of the reality? Today, we're going to break it all down. And when I say a monster rally, I'm not kidding. The stock surged over 50% in just a few weeks. Think about that. It added more than $100 billion to its market cap. That is just a staggering move for a company of Intel's size. So this all brings us to the big question. Really, the $100 billion question, right? Is this the real deal? Is the turnaround we've been hearing about for years finally here? And maybe more importantly for you, if you're watching from the sidelines, is it just too late to get in on the action? All right, so let's dive into that. To really understand if this rally has legs, we first have to figure out what caused it in the first place. I mean, this wasn't just some random market noise. This was fueled by a whole barrage of genuinely good news. It really boils down to four key pillars here. First, a massive partnership to build chips for Elon Musk's companies. That's a huge vote of confidence. Second, they deepened their alliance with Google to power their global AI infrastructure. Again, another tech giant betting on Intel. Third, they spent over $14 billion to buy back a key factory in Ireland, which signals some serious financial confidence. And finally, the market is betting that Intel can grab a huge piece of the AI pie, specifically something called inference, which is basically the thinking part of AI that comes after all the training is done. And this quote just sums up the feeling perfectly. The market isn't just optimistic here. It's aggressively, and I mean aggressively, betting that Intel's whole turnaround plan is going to be a spectacular success. But, a great story is one thing. The data underneath is something else entirely. So yeah, the story sounds fantastic, but now we've got to pop the hood and see what's really going on. Because when we start to analyze the trading data itself, the options market, the short interest, a much more complicated and frankly a much riskier picture starts to emerge. Okay, so what are we looking at here? On the left, you see the long-term bets, and they're pretty much perfectly balanced, totally neutral. But then you look at the right side, which shows what's happening right now in the day-to-day trading. That ratio, 0.51, is intensely bullish. To put it simply, for every one person betting the stock will go down, there are almost two people betting it will go up. That, my friends, is a sign of a short-term speculative frenzy. Now, let's flip the script. Let's look at the people betting against the stock. This number here, the short interest, tells us what percentage of all the available shares are being used to bet on a price drop. For Intel, it's just 2.4%. And to be crystal clear, 2.4% is incredibly low. I mean, anything under 5% is usually just considered market background noise. This number tells us that right now, almost nobody is willing to bet against Intel. It's like all the bears have gone into hibernation. Now, that might sound like a great thing, but it actually creates a really sneaky danger. See, when a stock falls, short sellers have to buy back their shares, and that buying actually slows down the fall. It acts like a cushion. Without them, there's no parachute. So what does that mean for you? It means if sentiment turns sour, you could see really sharp, really sudden losses with almost no warning. So with all this risky data swirling around, let's take a step back and try to look at Intel through a totally different lens. The framework of the investing legend himself, Peter Lynch. How would he size up this kind of situation? Lynch's whole philosophy was deceptively simple. Just ignore all the day-to-day market noise and truly, deeply understand the business you're investing in. So let's apply his strict numbers-first approach to Intel and see what we get. And this is where it gets really, really interesting. Take a look at this scorecard. Lynch would call Intel a turnaround stock, which, by the way, was already his highest risk category. But the real kicker is the PEG ratio, his all-time favorite valuation tool. It's over 3. Lynch looked for stocks under 1. That is a massive red flag from his perspective. You add in the heavy debt and the fact they slashed the dividend to pay for new factories, and from a classic Lynch point of view, this is a very, very tough stock to get behind right now. So the simple story, the one Lynch would demand you be able to explain, is this. You are betting that Intel can successfully build the most advanced chip factories in the entire world and steal huge market share from giants like TSMC. It is basically an all-or-nothing bet on their foundry business. Okay, so let's connect all the dots. We've got a fantastic turnaround story, but it pretty much fails the fundamental tests of an investing legend, and the trading data is screaming speculative frenzy. All of this points to one classic and pretty dangerous market setup. There's something called a crowded trade. The best way to think about it is like a boat where everyone has run over to one side to see something amazing in the water. Yeah, the view is great, but that boat is now dangerously unbalanced. And the overwhelming bullishness in Intel has created exactly this situation. And this unbalanced boat creates three very specific dangers. Number one, who's left to buy? If everyone is already bullish and has already bought in, that buying pressure just dries up. Number two, if any bad news hits, everyone is going to rush for the same tiny exit door at the exact same time, and that causes a price crash. And number three, like we just talked about, with no short sellers, there is absolutely no parachute to slow that fall. So here's the bottom line for me. The stock price has gotten way out ahead of the actual business results. All of the good news feels like it's already baked into the price, and then some. It's become what Peter Lynch would call a prove-it stock. And for me, at this price, that's just too much risk. The company basically has to execute flawlessly just to justify today's valuation, and that's exactly why I personally will not be looking to buy Intel right now. Which really leaves us with this one final question. With the stock trading at a sky-high multiple of 122 times forward earnings, you really have to ask yourself, are you buying a proven success story, or are you just buying the hype that you hope one day becomes a success story? So that's our breakdown of the wild story at Intel. If you found this explainer helpful for getting the full picture, do me a favor and hit that like button and subscribe for more deep dives. Thanks for watching.